Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is November 15th, 2023. I'm going to start with one video, just a clip from a video I did yesterday, which is the one thing I want to show, which is from Mohammed El-Arian, pointing out that the market is continuing to have volatility. And so whether the market goes up or down, or maybe probably both, we're going to continue to see, in his opinion, a lot of up and down volatility. And we've certainly seen that recently.
What a rally in the equity market inspired by a major bond market move. Your piece this morning, let's get straight to it. This line right here, for all of us who hope for greater certainty and less yield volatility. Mohammed, how disappointed are we going to be?
Thanks for having me, John. First, the rally has been driven not just by lower yields and a ton of refinancing that has allowed the capital structure to be strengthened for companies, but also by lower oil prices. Don't underestimate the impact of oil prices, both on the supply side and on the demand side, when it comes to the tip of a company. Now, we all want more stability in the treasury market. The treasury market is central to so many other markets. And having 8 to 15 basis points moves every day as something regular is not good for the functioning of that market. It's not good for other markets. It's not good for the economy. It's not good for the standing of the US in the financial system. So we all want greater stability. The Fed is moving off center stage. The Fed is going to have much less of an influence on where rates go from here. But unfortunately, that doesn't mean that the volatility is going to go away, because you have a tug of war that we're going to see playing out between issuance and between a softer economy. And that tug of war means that we're going to continue to see this volatility. But I don't think to the extent we've seen it before, because the Fed is not going to be confusing things anymore.
So do you think we are confusing a rally in the bond market with stability?
Well, it hasn't even been stable, John. Yesterday, we moved 8 basis points, and the stock market did nothing at all. But the bond market is still moving. There's still a lot of underlying tensions in that bond market. Issuance, John, I'll give an example that comes from a colleague at Gramercy. For the whole of October, there was 14 billion of issuance in emerging markets. This week alone, there's been 14.5 billion. So this week alone, everybody has rushed, understandably so, to issue because the volatility had kept them on the sideline. So the issuance element is contributing to what we see volatility, even though I agree with what most people will think, which is the Fed is done. It certainly should be done, and I suspect it is done.
Okay, I want to get into the dashboards first. The first dashboard is the indexes. What I've got is 6 equity indexes, 4 U.S. equity indexes, the NASDAQ, S&P 500, Dow Industrials, and Russell 2000 Small Cap Index, and then 2 foreign indexes, the developed markets, EFA, and the underdeveloped markets, EEM. And so all 6 of those are included. And then finally at the bottom is TLT, which is the 20-year government bond index. And they are ranked from best performing to worst performing in the pink box and just to the right of center. So you can see that the NASDAQ 100 has by far outperformed the others, and that is up 42% year to date. That is comprised heavily of the Magnificent Seven, the 7 top equity indexes, tech indexes, Facebook, Tesla, NVIDIA, Google, Microsoft, Apple, Amazon, and that pretty much holds up the market, and it holds up certainly holds up the NASDAQ 100. And followed that by the next one is the S&P, which includes those 7 among 493 others. And then you drop down to the developed markets, EFA, 5% gain for the year. And the Dow, which includes mostly value type stocks like Boeing, Johnson & Johnson, Pfizer, JP Morgan, etc., those companies, that is up 3% for the year. So you may think that the market has done really well, but the Dow is up 3%. Emerging markets up 1%. The Russell 2000, the small cap index, is down 3% year to date. And of course, the long-term government bond index down 11%. So it is not uncommon that if you have stocks and bonds, some mixture of all of these, and on the bond side could include intermediate term bonds, corporate bonds, etc., probably does, but they are all down. So most portfolios are still down for the year or barely positive, based on what I have been told from people who have called me. When you go over to the far right, you see the green dots or red dots. The green dots indicate that those indexes are above their moving averages, or the red dots are below their moving averages. Going from left to right, the 20-day, 50-day, 100-day, and 200-day moving averages. There are 17 out of all of these indexes, 17 out of 28 that are positive. Last week there were 16, so slightly better than last week. And the balance are negative. This last week was mostly a positive week, but it's interesting when you break down the market. There were 18 of the sectors inside of the S&P 500. So now we get away from the NASDAQ, we get away from the Magnificent Seven to some degree. Mostly we get away from it, and we look at the broad market and to break that broad market down into these 11 sectors, and then you start to see really what's going on with the market itself, not just with the tech oriented index, the NASDAQ 100 or the Magnificent Seven. Once you pull that out, then it gets a little more questionable. And here we have 18, okay, there are 11 sectors, 4 moving averages for those 11. So that's 44 opportunities to have a red dot or a green dot. 18 of the 44 are positive. The remainder are negative. That is down from last week when there were 22. So yes, the Magnificent Seven did well this week, but really a lot of the rest of the market did similar or not as well as it did last week. So we see that the financials and the XLF, the fifth row down, and the tech stocks, tech sector, XOK, the top line, those that were positive for over their 20, 50, 100, and 200-day moving averages. But the other thing is interesting, if you look at the pink box, that you've got the tech sector up 44%, the consumer discretionary up 24%, and then you drop down to industrials up 4%, and the rest of the sectors are negative year to date. So 8 out of 11 are negative, and 3, of course, are positive. The yellow box shows the ones that were positive or negative for the week. Again, quite a bit of negative. The tech sector did very well, XLK at the very top, but when you look down, telecommunications down 3%, energy down 3.7%, retail down 3.6%, etc. There's a lot of parts of the market that have not done well this last week, and for that matter, year to date. This shows a chart of the S&P 500 for an 18-month period of time. So a move in this chart, up or down, is a move of 1 week. So it's called a weekly chart. And you can see that to the far right of the chart that the S&P went up last week nicely and then continued to go up this week. So two weeks of gains. This followed about 3 months of decline. And but now it's back up above its 20-period moving average, and going from October of last year until November of this year, generally moving in a positive direction. Also, an 18-month weekly chart is where I do a relative strength or relative value, showing the growth component of the S&P 500, SPY G, divided by SPY V, the value component. The growth component would be the growth tech stocks generally, and the value would be those that are more focused on profits. I'll call them old economy stocks. And that has gone up and down. Last year, you can see right before this black arrow I put on, you can see last year it went down a lot, and what that did was it favored value stocks by that much, a lot. And however, this year, shown by the black arrow, generally speaking, has shown that growth stocks have been more in favor, including this last week, where they're at the very end of the chart, you can see a tick up favoring growth stocks. Then I do another relative strength chart showing the S&P 500, we'll call it the broad market, but it's large cap stocks. These are the largest 500 companies, and compared to small cap. Small cap is a denominator, large cap numerator. So as this goes up, this favors large cap stocks, goes down, favors small cap stocks. Since March, you can see the direction is dramatically up. What that is saying is large cap is way in favor when compared to small cap. So, and you saw that on the dashboard. Small cap up quite a bit, or large cap up, small cap down quite a bit. So when you put it relative strength, this is what it looks like, including this past week, which was another big gain for large cap and another loser for small cap. Long-term government bond has been in a decline for over 3 years now. I'm showing 3.5 years, 42 months, just to give you a sense for the magnitude of the loss. The loss actually goes back further than this, but I just showed 42 months. The last couple of weeks have been positive for long-term bonds. There's a little tick up at the bottom, but the long-term government bond came down from its high to its low about 50%. 50%. So if it goes up 1 or 2 or 3% for a week or a month, it's not going to make a lot of difference. I personally think that it is in a long-term downtrend, which means interest rates must be going up, and bond prices and bond fund prices will therefore be going down, because if interest rates go up, yields go up, bond yields go up, and of course that drives bond prices down. So I think we're in a long-term cycle. I don't know where it's going to end. You know, we will know after the fact when we establish a new trend, but I don't think we're there yet. The dollar continues a period for the last several months, has continued to go up relative to other currencies. So you may think the dollar is weak, but our currency, our dollar, is compared to other currencies on a relative basis, it is stronger. Gold had a down week. You can see 2 down weeks, actually. You can see that from the drop at the very right of the chart. However, the long-term trend going from last October to current is still in an uptrend. Silver, same thing, but not as much. You can see on the red line that silver has generally speaking gone up, but in the short term, in the last 6 months or so, there has been a intermediate term trend of silver going down. When you can put those two together in a relative strength chart, making silver the numerator, gold the denominator. When it goes up, that favors silver and vice versa. For gold, you can see I put for the last several months, I put an arrow showing the general direction favors gold. So if it goes down, gold. If it goes up, that favors silver. Bitcoin continues to rip into the atmosphere. It has gone up for the last month or so very nicely, and had another very good week. And you can see from last November to present, it generally speaking has been in an uptrend. And this latest move a couple of weeks ago pulled us into the market. And so we had participated in a lot of this gain, not all of it, but a lot of it in our Bitcoin strategy. But it is in a favored position right now. We'll just, I'm not going to comment about the future, but for the time being, it's extremely positive. Okay, volatility. Because the market has, generally speaking, gone up, there are, as I showed, there are segments of the stock market that have gone down, but the market itself, the S&P 500, has had a positive gain, and the volatility index, the VIX, the VIX, is a measure of volatility of the S&P, and because it had a gain this past week, it continued to pull down the volatility index. So now it's down around 14. It wasn't long ago. What is this, 2 weeks ago? It was up at 22. So it has come down very rapidly. And that's a positive indicator for equities. Asbury Research echoes the same thing with their Asbury 6. So you have 6 metrics that measure the stock market, and all 6 are positive. This is the cross-asset relative performance, comparing one asset class to another or one segment of the market to another. For example, I'll go the ones that are all the way across green, I'm going to read those, and stocks are stronger than bonds. Technology, the NASDAQ 100, is stronger than the broad market, the S&P. And high yield bonds are stronger than corporate bonds. Those are the ones that are strongest for the last week, month, and quarter. U.S. versus the world. This is interesting. So how does the U.S. index measured by SPY, the S&P 500, the ETF is SPY, how do we compare to other countries? Okay, let's go through this. Where other countries are stronger than the U.S., those countries are Brazil, Canada, Mexico, Italy, Spain, Japan, Hong Kong, Singapore, Taiwan, and Australia. Where the U.S. is stronger than other countries, we're stronger in all 3 categories, the last week, the last month, the last quarter. We're stronger than India and China and the UK, Switzerland, and Peru in all 3 categories. Very interesting. Kind of a mixed bag. Gold and silver. So as of Friday, you saw this on the chart, the gold and silver charts, gold was down 2.5% from the previous Friday. This is Friday to Friday, to a price of $19.43 per ounce. Silver, $22.31 per ounce, and it was down 4.1% from the previous Friday. The gold-silver ratio is 87 to 1, favoring silver being a better buy. The monster box. A monster box is 500 rounds of silver, generic silver, and pure silver, 99.99%, I believe. And the monster box costs, as of last Friday, $12,290, in case you want to buy one. This includes a $2.27 markup over spot. So remember, I just showed you the spot price, 22.31. So you put 227 on top of that, and then you get the discount for buying 500, and that's 24.58 per round, and 25.08 if you bought just a tube. And the source of this information is my son, Preston. I'm glad the stock market closes on the weekend. It gives my fingernails a chance to grow back. Thank you for watching. If you have questions or comments, leave them in the comment section below.